So with the announcement of the How to Invest HQ portfolio, there's been some interest in how exactly I'm going about picking the stocks that I'm going to be investing in. And essentially, I have a short list of about 10 stocks that I was watching. I've already picked one, as you may already know if you've been following along. And what I'm going to do is I'm going to go over the 9 stocks that I'm watching for the portfolio. I'll discuss why I like each stock in particular. And since I'm only picking one stock per month and will stop around 5 total stocks, the purpose is to show how I go about deciding between good stocks. I do have some reservations about every stock, which I'll share with you in this video. And the purpose, though, is really just to say, hey, there's lots of great stocks, but which great stocks are also great buys at the current price? And I'm basically going to be deciding that on a month-by-month basis as I pick different stocks for the fund. So I've already picked LinkedIn, if you've seen the January update for this month. And I was able to get that at $200, and now it's already up to about $217. And that's what I mean by, finding it at a good price. I thought 200 was a great price for LinkedIn. I still think 217 is a good price. So I'm not just looking for great companies, but I want to find great companies that are priced right too. And I'm going to, have this list of 9 stocks, and on February 1st, I'll look at the prices of all 9, and whichever one I think is priced the best is what's going to go into my portfolio. Okay, so here's my 9 stocks that I'm looking at. And the first one's going to be an Apple, and these are in no particular order. I like Apple because they have great earnings, they have tons of money, they're, adding to that cash flow every quarter, they pay a dividend, and they have a good buyback program in place that's big enough to actually be meaningful, and they're, generating so much money that they could eventually buy back a large portion of the company. And I'm investing in Apple where I like Apple. I do hold Apple long myself outside of the portfolio. And that's because I believe that iPhone and iPad sales will continue to increase. And I think that any new product lines will be a bonus. The street's kind of holding their breath, waiting for Apple to produce, the next iPad. They had this iPod that was, okay, this is cool and new, even though it really wasn't any different than an MP3 player. It was just packaged nicer. And then there was, the iPhone, which really was truly a step forward and completely unprecedented. And then there was the iPad, which was the same sort of deal as the iPhone. The complete game changers. Apple doesn't need another game changer. That's my position, Apple. If they do come up with another one, great. If not, they can keep selling iPhones and iPads, and I think they'll keep selling more each year until someone makes something better. Samsung might try to match the iPhone or iPad, but matching doesn't win. They've got to beat it, and just right now they're not. So until somebody beats the iPhone and iPad, I'm happy investing in Apple. And I guess my primary reservation or fear with this stock is that the market continues to ignore the fundamentals and the stock kind of drags along in price. And I say that because Apple's been still growing revenue and the stock's down a lot on that. And that's just not right, especially as they're getting more valuable, buying back more stock. Okay, so another company I like is Amazon. And they have massive revenue and fast growth. I like Amazon because I think e-commerce is the future, and Amazon is clearly the best in that space. I mean, the only really competitor I can think of would be China's Alibaba and whatever their Amazon equivalent is. I'm pretty sure they're both owned by the Alibaba group, so they're sort of the same company. But we're still a long ways off between the two, and I don't see. We're still a long ways off from a Chinese e-commerce site selling directly to the U.S. consumer. Alibaba will sell to businesses that are reselling, but those same resellers are using Amazon, and Amazon has access to those same manufacturers, so I don't really see that being an issue. Amazon's more of a retailer than a manufacturer anyway. Other companies are manufacturing their goods, Amazon's being a retailer for them and selling them at low prices. I also like Amazon because they're the clear leader in ebooks, which are highly lucrative just because there's no cost associated with distributing them. They sell them, they take their 30% cut, and that's it. They sell something for $10, they pocket $3, and there's no cost associated with that. And they're also the leader in cloud services. They have a huge cloud hosting platform, which if you don't know anything about it, just understand that a lot of websites and services are moving their processing power to the cloud, and server costs and those sort of business services are always high margin products, and Amazon's leading in that space. It's making a lot of money off of it. A lot of people don't realize that that's going on in the back door. Amazon's doing very well there. And the primary fear with Amazon, which I don't really think is even going to happen, is that the market stops valuing their revenue and revenue growth. Right now, Amazon hasn't been able to demonstrate any earnings, or so a critic might say, but that's just because they're spending all of their earnings on more infrastructure. They're building, fulfillment centers everywhere so that they can more efficiently give out their 2-day shipping and their free ground shipping. And ultimately, what they're planning on in 5 years or so is 30-minute delivery with drones on light products. So this investment's necessary, and I don't see the market not valuing that anytime soon. Another primary target for me is going to be Google for the How to Invest HQ portfolio. And I like Google not because of traditional reasons. A lot of people think of Google as a search engine, the owner of the Android operating system, and they think of Google for their sort of zany ideas like Google Glass and self-driving cars and all their good nice services like Gmail and that. And what I see there is I see a huge ad network. And basically that's really Google's strength. They have all this data, they have all this user attention, and they're using this to deliver ads. That's the real value. Internet ad spend is increasing by double digits every year. What I mean by that is over 10% growth. It's somewhere in about 15% growth each year. And Google is by far the number one player in this space. And this is going to be $1 trillion industry within the next 10 years. And Google's that means $1 trillion of ad spend every year is going to be happening on the internet by 2020. Maybe a little bit later. 2020 might be a little bit aggressive, but definitely by 2020. I would say definitely by 2025, barring some kind of great economic catastrophe. And Google is just by far the biggest player in this space. Now, I really could care less if Android is unable to crush iOS. I don't need Google to have Android. Android's just another way for Google to display its ads, but even if everyone uses iOS, Google is still going to be able to show iOS users YouTube videos. They're still going to be showing ads when people visit websites displaying AdSense. Google has something called AdSense, which is where a webmaster can put Google ads on their site. And this is by far the most popular form of internet advertising. Advertisers spend money through Google to be featured on sites and banner ads and text ads, and Google pays out the advertiser 68% and keeps 32% for themselves for setting up the transaction. Now it's really profitable for a webmaster, so Google's pretty much able to monetize a lot of the internet's traffic. So as long as more people keep using the internet and keep watching YouTube videos and searching google.com, Google's going to do well. And those sort of things show no signs of slowing down. Another one I really like is Chipotle Mexican Grill. I've been an advocate of them for a long time. I like them because even though they've been growing quickly, there's still plenty of room for increased revenue. They can still add more Chipotle stores locally in the U.S. and Canada, and they barely touch international expansion. And they also can raise menu prices. Their menu prices are very low, and they're ready to go up. Other similar stores like Panera or Five Guys or any other sort of fast casual chain that you might have in your area tends to actually be a little bit more expensive than Chipotle. In my area, a Panera sandwich is $7 and change, and a burrito is $6.37. There's a market difference. It's almost like 15 or 20% cheaper between meals. And not only are they cheaper, but they're the best in breed. To me, no other restaurant is fast casual restaurant is so far superior to its competitors as compared to Chipotle. Like they invented this space as far as I'm concerned, and they're positioned to dominate it going forward. There's tons of growth left. And they even have the two opportunities with Shophouse and Pizzeria Locale. Shophouse is what they're calling a Southeastern Asian kitchen. I've actually eaten there. There's one in Washington, D.C. And it's interesting. It's similar to Chipotle, but definitely different. And they're basically looking, with Shophouse, they're kind of looking to take on almost provide a fast casual version of Chinese food that's just not quite the same as traditional Chinese food. And Pizzeria Locale is sort of the same fast casual concept with pizza. So these also two huge businesses, Asian food and pizza. There's tons of room for growth. The only reservation I have about Chipotle is it's kind of expensive right now. And what I mean by that is Chipotle is always expensive because it has this good revenue growth and has so much potential, but it's expensive for itself. So what I mean by that is normally Chipotle's profits to earnings ratio, even when Chipotle was trading somewhat high, was in the 40s, like 40 to 45. When it got crushed by the short sellers, it was still up, 30, 33, and now it's at 54, which is, or 55 even by the time of this video. That's really high for Chipotle, so I'm keeping an eye on it, and hopefully I can get it cheaper. If I can get it back down in the 40s, I might take it. But at 55, it's hard to take it at that price. And another stock I'm looking at is AT&T. That might be surprising, given that it seems like if you're looking at this list, I go for mostly growth stocks. I like AT&T because they provide a huge dividend. They operate in a growing sector and one that happens to have growth margins. Cell phone service is not expensive. Really, they'd have, be extremely profitable if they didn't have to subsidize phone sales. But with programs like AT&T Next and selling data plans for tablets, AT&T's got good ways to, boost their revenue going forward. And the primary reservation is that for some reason they just aren't able to eke out enough profits to pay their dividend, and they either have to skip it a quarter or fail to increase it. That could result in a big drop in the stock. But they've been pretty consistent, and I think that smartphone service is a really growing sector, and it's a profitable sector. I just don't see how they can miss it. And moving forward, another potential acquisition for me is going to be Panera. I like them for the same sort of reasons as Chipotle. They're a good concept. They're a strong restaurant. They have good margins. And the stock itself is pretty cheap. They can definitely grow more with local growth. Their market cap's somewhere around $5 billion, and Chipotle is over 3 times that. But the primary reservation I have with Panera is that there's no upside after they completely saturate the United States and Canada. I mean, maybe they can go internationally, maybe they can't. It's not a test. They're not proven overseas, so I'm not going to, say that they're going to do well overseas. We really don't know. And they don't really have any room to raise their menu prices. To me, Panera's already on the expensive end. Like I said, Chipotle is pretty cheap. They can move their prices up. So the only reason I really like Panera or put them in this list is just because the stock seems to be trading at a discount compared to its historical sort of value. And the profits to earnings ratios in the 20s. Yeah, growth is slowing down, but they're still, they can still be worth more than $5 billion. I could see Panera growing into a market cap of about $20 billion without major international expansion. And even with some, that's including some stores in Canada and Europe. But beyond that, I still think they can be definitely increase their value. But again, I'm mostly looking at them given that they're cheap right now. Not that I think that they're a much better company or going to be bigger than Chipotle. I don't see that in the cards. Another one I'm looking at is Zillow. I've talked about them before. They're increasingly involved in the home buying process. If you've never been to that site, it's basically a directory of pretty much every house that's for sale or been sold, including historical records, prices in the past, maps, pictures, everything. And what I really like about Zillow is that as it's becoming more and more important in the housing market, their ads are becoming increasingly profitable. And what I mean by that is people are discovering that they can actually sell ads or sell houses through Zillow, and now sellers, apartment owners, real estate agents, they're all starting to fight for advertising space, but there can only be so much advertising space on a website. And so how most websites will do their revenue is its auction system. Whoever wants to pay the most gets the ad. The more people interested in the ad, the more expensive it is. And companies that sell and buy houses and people that sell and buy houses are becoming increasingly aware of how important this site can be and how profitable it can be and how much traffic it can drive to your property. And they're starting to bid on ads. So we're seeing this explosive revenue and growth with Zillow. And I really think that we'll see even more because millennials, that is people born in, around the turn of the century or coming of age around the turn of the millennia, not the century. I guess both work. So let's say people born from, I guess they usually, a lot of times, sometimes they'll go back as like 1980, 1985 and up. As these people of this age start to reach home buying age, starting from say now, the first millennials might be buying their first house. In the next 5, 10, 15 years, even more will be buying houses online. In 15 years, most houses will be bought online. That's what I believe. Of course, they're going to want to look, people are going to look at it, but, the whole finding the house, checking out virtually, negotiating a price, that can all be done online. And once everything's set, they can go out with an agent and an inspector, or even by themselves. Agents might start to be cut out. A lot of agents are getting involved in Zillow for that reason. The point is, though, that as more and more people buy and sell on this site, the more profitable it's going to be. It can be explosively profitable. And it's one of the most popular sites in the United States as a result already. My primary reservation for this site is what's called a Google algorithm shift. And that's basically, right now when you type in any major city, combined with keywords like real estate or houses for sale or homes for sale or whatever you can think of, similar, whatever you search Google if you're looking for houses. You type in houses Denver, real estate Denver, Denver real estate, Denver houses for sale, dream houses Denver. Things like that. You see Zillow pop up in the top couple results for pretty much every city, for every term you could think of. And that's because Google thinks that people are looking for Zillow, and Zillow's got good, what's called search engine optimization. As a result, Zillow shows for these terms. Well, if Google was to somehow shift their algorithm, and the algorithm, which is basically how Google calculates its results, if Google was to mess around with that algorithm a little, Zillow could lose half of its traffic overnight, and they could lose half of their revenue overnight. So it's a very precarious situation. But I think that over time, this sort of fear fades because more people are recognizing Zillow for what it is, and that's basically the best real estate site. So as a result, they're just going to start going directly to the site. They're going to start to bypass Google. I mean, Google still gets a lot of search volume, but a lot of people go to Zillow. People don't search Google for social network. They go to Facebook.com and use their social network. So it's the same sort of thing will happen with real estate eventually. Millennials now probably know to go to Zillow. Some might go to Trulio or another competing site, but those, have used all the services. They know Zillow is the best, most comprehensive. So they're going to use that one. And that'll sort of reduce the effects of the algorithm shift. And another similar site is Yelp that I'm watching. And it's basically the same sort of thing as Zillow, except people look up restaurants and local businesses. Mostly used for food, so restaurants, takeout, that sort of thing. But also, especially in metropolitan areas, you'll see doctors, attorneys, mechanics, florists, all kinds of small businesses show up. And what people do is they review these businesses and post them publicly to their profile. And people make friends on the site and can read other people's reviews and comment on their reviews. And as a result, it's a really sticky social network. People love commenting on here. It's kind of different from Facebook because a lot of people on Facebook aren't interested in reviewing restaurants. This is not something they do. And as a result, you kind of get people, there are some people that do like to do this. And if you ever read Malcolm Gladwell's book, I believe it was in The Tipping Point, he discusses that there's 3 general personality types where people either find themselves as connectors. Those are people with lots of friends who, frequent multiple social circles. I think there was something called a pusher or persuader who basically convince people to adopt, they're basically good convincers. And finally, there was what's called a maven, or someone who collects information. They love sharing information. They love collecting information. I definitely identify with that last one. It's kind of why I have a stock site and a YouTube channel talking about stocks in the first place. And as a result, people who are mavens, they love sharing reviews. And this is basically, Yelp is like a haven for mavens that like food and business, which is most people. So they have like this really sticky social network where people are just constantly generating free content for them. They don't do anything, and they constantly have up-to-date reviews on millions of businesses because all the users are doing all the work for them. And what's really nice about Yelp is that their advertising is really profitable because when people are using Yelp, they're looking for information on businesses or restaurants, so they're getting ready to eat at a restaurant or buy a service from a business. And if you can advertise to someone that's this far along in the buying process, you're likely advertising to a buyer, potential buyer, and it's just more likely to convert so they can charge more money. And as a result, Yelp's starting to make a lot of money off its ads as more people realize, small business owners realize that they can advertise on Yelp and do quite well. And as a result, Yelp's actually the 36th most popular site according to Alexa, which is, pretty popular, right? Well up there. And I have the same sort of reservation about Yelp as I do with Zillow. And that is that Yelp gets a lot of traffic from Google search. People type in restaurants Baltimore, or restaurants Denver, or restaurants Los Angeles, and Yelp comes up. And if for some reason Google was to shift their algorithm to push Yelp down, which I'm not saying that they would do something so sneaky given that they own Zagat, which is a review service, and might want to try to push up their own reviews, they could kind of they could definitely try to hurt Yelp a little bit. But like Zillow, a lot of people are going directly to Yelp now. So as more people discover Yelp and realize, what it is, how it works, this is going to be less and less of a concern over time. So my last potential acquisition is going to be Under Armour. I liked Under Armour for a long time. They were growing rapidly in the apparel space. And what I really like about Under Armour is that they have big margins. They charge a ton of money for their products that just don't cost that much to create. So as a result, they're able to, even though they trade at a profits to earnings of like 60 to 65 at the time of this video, that's actually kind of low considering how quickly they're growing revenue. And the reason is, and how low their revenue is compared to their market cap. And just because they have huge margins, they're spending money on expanding their infrastructure and selling to more places. It's just that they charge so much money. Their product doesn't cost $60 for a shirt or a hoodie, but that's what they charge, and that's what people pay. And that's just because they're a very strong brand with appeal and with the right audiences right now. That's like high-end fitness and sports teams. People like the Under Armour brand right now, and that's kind of a little bit the problem. That's a little bit of a reservation of mine. Is the Under Armour wouldn't be able to charge this kind of money if it wasn't considered cool. Right now, Under Armour is considered very cool, and that's what makes it easy for them to sell and grow. It's not a big problem for them to charge $60 for a hoodie because people want to buy them. They ever lost that coolness, kind of like Nike has. Nike's just not as cool as it used to be. Especially for apparel, its prices are going to have to come down, and then it's just not going to be worth that much. And the reason is they have a lot of growing to do to justify their current price. They have high market cap, low revenue, and compared to their revenue, I mean, Nike's market cap is, I want to say, just over 3 times, or it's about 3 times their revenue. Under Armour's market cap is about 10 times its revenue, just by comparison. I mean, obviously Under Armour's growing quicker, and the profits to earnings ratios are a little closer, if not, almost 4 times off. But Under Armour does rely on its coolness to generate margins. So I'm on board as long as they're cool, but as soon as they're not cool, I'm thinking about stepping off. So it's just one to keep an eye on, but I don't really see them being not cool anytime soon. So that's it for this video. You now know my 10 picks for the portfolio. I've already picked one, and over the next couple months, I'm going to be picking a few more. So subscribe to my channel for updates so you can see which one I picked, which one I end up picking, and why, why I think it's a good buy. I'll go into more detail about each pick that I actually make. So if this video is helpful for you, subscribe and follow along.